Jeff here, No Zoom Mondays. Over the last few weeks, I've been seeing a lot of questions about how to reach your FIRE goals financially, your FIRE goals, financial independence, and retire early, or just reaching financial independence to do whatever the heck you want when you want to. And so those questions have come up. I'd like to take a minute to take a look at the questions. They're as far left as selling everything and getting out of the market to far right with regards to, just holding on and continuing to invest just like you have year after year, month after month, etc. And so although I have retired early, I still expect a 30-year income stream through my portfolio. So I've taken an active interest in looking at the latest strategies to best achieve that. I've done some recent research and I want to share those results because what I found was they surprised me and continue to promote me towards a certain direction and a certain strategy, which I'll share with you through this video. So if you're interested in hitting FIRE, or you have fired and still need a portfolio to produce results, stay tuned and let's dive in. The first strategy is to sell everything and stay out of the market. Just sell and run. I would offer up that this strategy is an extreme strategy. It's one I think people, from what I can see, are doing it. Some of the posts I've been seeing. Let's look at some pros and cons, right? The pros here, certainly if you're selling out of the market, you have some fear that you're losing money or will continue to lose money, and would offer that it's probably going to lower your anxiety level or lower your fear if you don't have money in the market. So that's a good thing. You would also have cash on hand at this point if you sold everything, which would give somebody an opportunity to pay off debt. If you have a mortgage, maybe pay more to that. If you've got credit card debt, pay more towards that, car loan, etc. Again, in the world that I live in, retired early without debt was an important key so that I didn't have high fixed expenses. In the con section of this strategy, again, trying to meet your FIRE goals, I'm assuming you lost money, or somebody would have lost money at this point given the market's down. The S&P anyway is around 20% down, so you're guaranteed to lose that money and not finding a way back in the market. Would also offer up that there's going to be a tax consequence because you sold something and lost money. It might be a positive consequence in the sense it reduces your taxes, but on the negative side, if you made some money, you've got capital gains, and now you got to pay those capital gains at a higher rate. The last thing as a con is the fear of missing out. The market's been alive for 120 plus years. There's been 12, 13 different recessions, multiple depressions, multiple days, well below 10% performance in a day, et cetera, and the economy's always been resilient and the market's come back. So to that, I would offer up that you might sooner or later see the market come back and you missed it. The risk to this strategy and meeting your financial FIRE goals is high, given what I just spoke about. Not sure really if you've taken your money out of the market, what your investment alternatives are going to be. I'd love to hear about them. If you'd like to make some comments about what you're thinking about doing, maybe putting money all into real estate, buying rental properties. How about Bitcoin? I've heard people thinking about Bitcoin as a strategy to go forward, offer up. That's an alternative investment. It's not done so well as of late, maybe thinking it might turn around. The last one might be art. I heard high investment art. I'm not an art dealer. I wouldn't know what to look for, but perhaps others on this channel can help us understand how you might do that and diversify even more. So those are curious what you might do with the cash if you follow this strategy. As for me, would this be my FIRE strategy going forward? I would offer up, given what I've just spoke about, and I still am looking and expecting for 30 years of positive returns to be able to pull from my portfolio. The market is going to be my catalyst for that, my engine, if you will, that I'm going to ride. I've done it for 35 years. The research I've done shows that it's high single digits, if not double digits, over the course of, on the averages over the 120 years it's been in existence. And so I'm going to use that as my engine to continue to grow. So no, this would not be my strategy. The second strategy to hitting our FIRE goals that I keep hearing about is sell everything, but buy back later. Maybe when the market is going to continue to go down, you buy back when it's going to rebound. The pros to this is it will absolutely maximize returns. And by that, you really have hit the holy grail. You're buying low and you're selling high, and you're going to continually do that. Theoretically, you continually do that and you maximize your profits. It'd be great if you could do it. Certainly would lower anxieties and fears. You're going to get the best price every time you trade. So you're definitely not going to have fears of, if you will, being in the market, selling now and then getting back in later. Of course, to cons, let's take a look at the negatives, and the first two are probably the most important. It's improbable in the sense of execution. Not only do you have to be consistent on getting out of the market at the high point, but you also have to find a way to get back in before it rebounds twice, and this might happen multiple times in a year. So now your odds of hitting that are pretty improbable. And then the second one is how do you know when to buy in? If you're an average investor like me, are you watching the market? Are you really following along, daily, hourly, etc., to make sure you get in at the right time? I'm not, and so I would think with these two, do a double click though to amplify the point that I'm trying to make here. And I'll do this with some studies that I found. First study is from Putnam, and Putnam, as you'll see here, did a study over the last 15 years of the market on the S&P as a proxy for the market to say if you invested $10,000 at the beginning of 2007 and held it until the end of 2021, what would have been the return? And that $10,000 would have returned $45,000, 600 bucks or so, about a 10.6% cumulative growth rate every year, which is fantastic. Inflation was not anywhere near that. A very, very high positive return. Okay, so that's great news if you bought and held like most long-term investors do. However, let's take a look at some of these red lines. The first one says, hey, look, if you didn't time it right and you missed the 10 best days of performance of that S&P 500 in that 15-year period, your return now would only be 5% on an annual average rate, or $20.9 thousand. Okay, so you've halved your return if you've missed just 10 days of that 15 years. You look down a little bit lower, if you missed the 20 best days, if your timing was off and you missed the 20 best days, your return now in that 15-year period would return only 1.5%, about 12,000 bucks. And again, if you look at the next two lines, missed the 30 days or missed the best 40 days in those 15 years, you got negative returns on your asset of that $10,000 put in at the end of 2006, first day of 2007. So timing is critical, and I don't know about you, but that would be a big risk to me to miss the timing on that. The next study I'll show to, again, amplify the point of timing is difficult is from Bank of America, and there's a lot of numbers on this chart, but take your eyes down to the last bolded row of all the numbers and percentages. What Bank of America did was looked at performances of the S&P 500 per a decade starting in the 1930s, 1940, 1950, 1960s, etc. What they did is the first full column, it says price returns. Another word for that is buy and hold. So if you bought in 1930 and held until now, the bottom number there, the percentage, 17,000.7%. Percentage return is what you would expect if you bought and held the S&P 500 in the market. The column over, and again, we're worried about timing here. The column over says, hey, look, if you could skip all the worst 10 days every decade, you just don't, you get out of it and don't lose the money, you have a chance of taking that 17,000% and moving it to 3.7 million% of a return if you were that good at forecasting when to get out of the market. The next column is even more telling. It says that if you would miss the best 10 days of each decade from 1930 to 2020, you would end up with a result of only 28% return. So a buy and hold strategy would have gotten you 17,715% to 28%. So timing is absolutely critical. And again, I don't have my fingers on the pulse of the market that much to be that quick and that correct on timing. The other things are going to have tax consequences a lot because you're buying and selling all the time. You have to pay taxes on. So again, as a risk, it's definitely riskier to meet your goals this way, to be able to time the market as many times as you would have to. Because of that, this would not be my f.i.r.e strategy going forward. The third strategy one might try to deploy to get to their financial goals on f.i.r.e or live with them as you retired early is the hold now, don't sell anything, and buy in later. So a bit of a mixture of the last one. Just don't sell anything now and then use any additional cash you have coming in not to buy into the market today, but buy in at a later date. So the pros to this are, well, it's simple and easy. You do nothing. You just basically are letting everything fly as is. You've got number 2 there says you're going to have a cash buildup. You are building up your cash. Anything new, maybe you've got an income to allow you to pay off any debts you have, which is fantastic. Also might allow you to build up your emergency bucket if you don't have that done as of yet. And since you're not selling, there's no tax consequences, which would be another positive. Okay, for cons though, you've got to worry about when to buy in again, right? So now you've got this cash accumulating. Are you buying in 6 months? Are you buying in a year? Are you buying in when inflation comes down to 3%? And all those decisions you have to make. And again, with that, you might have some buyer's remorse. Well, shoot, I should have waited to buy because the market went down further, or I should have got in sooner because it went up sooner than I thought it was going to. And those would be missed returns as well, an opportunity to lose a rebound and you not being in the market. So those would be cons in this strategy. I would offer up that this would be a medium risk to your FIRE goals because you still are staying in the market. Again, this is the engine that we're all using to try to get to retirement early and hit our financial independence. And I'd say it's medium because you're only timing once. You're going to buy later at some point. You're not selling today and potentially missing out. So given what I know of the market and what I said earlier, the idea that all the transitions our economies had to go through and inflations and Fed rates up and down and some wars along the way since the market was created and the depressions that happened, the recessions and all these things, our economy continues to come back and the market continues to come back. I would offer up that this is a okay strategy, but not one that I would follow to the T. Let me share with you the one that I would follow. Strategy number 4 to hit the financial numbers we're looking for is hold it now, similar to the last one, but continuing to invest as you get additional cash coming in from your income sources. The pros to this is no matter what happens, whether the market's fallen, you're buying at a lower price because you're continuing to invest cash. If the market starts to go up, you're continuing to invest cash and you're buying on the way up as it goes up. So again, it's still lower prices than what if you did just wait or not getting back in at all. You're not selling, so there's no tax consequences. I think that's healthy. Taught a long time ago, you want to take taxes at your lowest potential rate. Any additional income or capital gains might cause you to pay higher taxes. The cons here on this strategy, there are several. You still have to buy in, even though you're getting either paychecks every month or every 2 weeks or quarterly, you might get a bonus. You still have to make a choice as to when to buy in. And that might give you anxiety or fear because you might decide, well, should I wait? The market's going to continue to go down. The market's going to continue to go up. I need to wait to the right time. So you might try to start to time the market. And with that, I want to share the most surprising results, which is a study that was done by Schwab, and this is key. The Schwab study is cool because it's taken 20-year look, the last 20 years from 2001 to the end of 2020. And it's taken a look at the returns based on somebody allocating $2,000 a year into the market, into the S&P 500. Again, that's the proxy here. The other thing that it did is it changed a couple variables. The asset, the 2K that's been invested every year, the first 4 columns are showing you a different timeline in a year that investment is made. And the last blue column here is showing you that investing that $2,000 a year into basically a savings account, or in this case, a 30-day short-term treasury bill, very conservative, but getting a return based on that type of asset. So, number 1, the first blue column that shows, over 20 years, $2,000 a year input, or 40K input by an individual. The results over the last 20 years of this study was the person would end up with 151K if you were perfectly timed, which means that you actually put the money in best day, the lowest rates of the S&P 500 of that year. So this was perfect timing. You picked the right day. Obviously, this doesn't pass, so they know exactly what day that is, and then calculate your returns forward. This is about a 12% return, just over 12%, and that's a fantastic return if you were perfectly timed. Now, the next 3 columns are when your timing isn't perfect. But the second column is a person that took the money whenever they received it. Let's say January 5th, they got a bonus every year, that $2,000, and they invested in it on January 5th, period, that they just invested the dollar. In this case, person ended up with 135K total dollars In that 20 years, again, you invested 40K, it's 135K net in that 20-year period, and you ended up with a CAGR, a cumulative average growth rate, of around 11%. A little bit different than the perfectly timed column, the person that did it, 15K, but still a healthy return at 11% per year. The next column, the third column over, is somebody who invested every month. They took everything of that 2K they got and invested monthly. So it's dollar cost averaging. And in this case, the total sum is about 134K, same CAGR, about 11%, as the person who actually just did a lump sum, put it in the market all at once. The fourth column is the timing is the worst timing. So they went back and they did timing on the highest point of the S&P in a year, and you bought then. You couldn't have gotten it worse. You buy it at the high point. Then they calculated the returns that way over the 20 years. And in this case, total return was about 121K. Ended up being a CAGR of about 10%, but still huge with regards to the overall market, and not so far off as these others as well, but they put the money to work. Now compare that to somebody that maybe took the money and didn't do anything, didn't invest, or invested in a savings account or treasury bills, something that was very conservative. You can see here the last column shows somebody ended up with $44,000, and they put in 40. They got 44 back after 20 years, which gives you a CAGR of around 1%. That doesn't beat inflation and wouldn't beat inflation going forward either. So I would say that shows you that even the worst timing, doing it at the worst possible time, investing that 2K in this study, shows you that it's better than going into conservative and putting everything into cash and sitting there. So what's the net of this study? You say, well, wait, Jeff, sure, it shows the perfect timing is the best way to get your return. We know that that's the holy grail. Everybody else did well by putting their money in, but this has been an up market. Well, don't forget those 20 years. We've had 3 recessions in that. We've had multiple days that have actually the market has fallen with 10% or more. So this has been a very turbulent 20 years of market performance of our economy. So it might be indicative. But let's just continue with the study that Schwab did. Schwab continued this and said, well, wait a minute. Okay, let's 20-year rolling averages from 1920 on, all the way up to today, and see if the results change. And up to 90% of the results over 20-year rolling periods from the beginning of the market basically till now, it's the same identical results. Perfectly timed is best, dollar cost averaging and just putting lump sum money in, and bad timing is still way, way better than not doing anything at all. And that was 20 years. Schwab also did it for a 30-year period and a 40-year rolling periods and 50-year rolling periods, and all very consistent. So if your time horizon isn't 5 years or less, which I would offer, you shouldn't be in the market with that money anyway. Given that, if your time horizon's 5 years or more, that there's a really strong chance that investing sooner rather than later is better than doing nothing with your money. And so going back to the number 4 strategy to get to your financial goals, for FIRE, the risk is very low because we've been doing this all along in regards to using the market, buying when it's going down. It's a standard business cycle. About every 7 to 10 years, the market comes down and ends up going back up for a long time, and it goes back down again. And you want to be buying when it's down. So yes, the number 4 would be my strategy. I would continue to do it. And as for how I place my bets going forward in this year for sure, maybe next, I would offer up that I would use dollar cost averaging as my scenario. I put money in, quite a bit of money in January. It was still super high, and I had buyer's remorse because the market started to fall. Had I done dollar cost averaging then, it would have naturally flown where I would have gotten pricing of stock and assets cheaper along the way. So as and if I get cash in any source of income as I move forward this year, I'm going to continue to invest, but I'm going to invest it using dollar cost averaging on a monthly basis. So if you've gotten some good information out of this, please like the video. If you haven't subscribed to the channel, please do so. There are probably people out there going, great, now I'm ready to invest, or I've started investing, but I don't know what assets to buy. I have highlighted the financial blueprint I have down to the exact stocks I've bought through some studies that I read and used conventional wisdom to buy these stocks. And it's been performing well, and I offer up that this video is something you'd want to watch if you have questions about what assets to buy with the cash that you have or the portfolio you're trying to build. Thank you. Bye for now.